Okay, let's get started with trying to analyze P&G's financials, or at least its income statement and balance sheet. This is the index of the report, which will allow us to find the information that we need much faster. According to the index, we will be able to find the company's statement of earnings, the income statement, on page 45, while its balance sheet is on page 47. Very well. Here is the company's income statement. We can disregard the information that is below the net earnings line, as it is out of the scope of our exercise. Let's go to page 47. Here is the company's balance sheet. Most of the accounts are exactly like the ones that we've seen so far in this course. Very well. Now I'll transfer the information that we have in this PDF file into Excel, as this will allow me to work with the numbers much easier. I'll see you in a moment. Right, so here we are. This is how the numbers look in Excel. I've used the exact same numbers as the ones that we saw in the PDF file. In the two sheets here, we have P&L and balance sheet numbers that are ready to be examined. We can calculate each of the ratios that we mentioned in our previous lesson, which would allow us to gain an idea about the company's business. I'll calculate the ratios in the cells that are colored in gray. In our previous lesson, we started with liquidity ratios. In fact, the first ratio that we saw was the so-called current ratio. Let's calculate it. On the right side of the screen, you'll be able to see the name and formula of the ratio that we're calculating. The current ratio is given by current assets divided by current liabilities for the respective year. And the result is that P&G's current ratio in 2014 was 0.94, and precisely 1 in 2015. It is a bit low, but at the same time, the company's business is well established, and it has strong bargaining power when negotiating with suppliers and clients. This allows P&G to operate comfortably. Okay, let's continue. If we want to calculate P&G's net trading cycle, we'll have to calculate its DSO, DIO, and DPO. DSO is equal to trade receivables divided by the company's sales for that year, which is then multiplied by 360. Okay, here's the result. We can copy it to the right. Perfect. Let's calculate DIO and DPO. In order to obtain DIO, we need to divide inventories by the firm's cost of goods sold for the respective year and multiply by 360. I'll have to put a minus sign in front of the formula because COGS are negative in the income statement that we have here. Very well. Let's do the same exercise for DPO. We have to divide accounts payable by COGS and then multiply by 360. Again, we'll need a minus sign in front of the formula because we are calculating days, and days can't be negative. Excellent. We can now calculate P&G's net trading cycle, which is equal to DSO plus DIO minus DPO. You shouldn't be surprised that the number became negative in 2015. In fact, we can see that the company was able to reduce its DSO and DIO figures while continuing to pay in more than 70 days to suppliers. P&G is able to operate its business without significant working capital investments. This is proof of the company's strong bargaining power. Its clients pay in every 3 to 4 weeks, while P&G pays its suppliers in more than 10 weeks. Perfect! The next two ratios that we'll calculate will give us an idea of the company's solvency. Do you remember the solvency ratios that we saw earlier? The debt ratio shows the business's ability to pay long-term debt, and the interest coverage ratio gives us an idea about the company's ability to pay interests. Starting with the debt ratio, both of the parameters can be found in the balance sheet, and I'll calculate it here. We have total liabilities divided by total assets. And voila! Copying the formula to the right, we can see that the ratio remained flat in both years. The value of 0.51 is below the threshold of 0.67 that we mentioned earlier, so that's good. Let's go to the income statement sheet where we'll be able to calculate P&G's interest coverage ratio. We'll have to divide EBIT and interest expenses. I'll put a minus sign in front of the formula in order to have a positive result. Okay, so we can see that P&G's operating income EBIT is approximately 24 times its interest expenses. This is completely reassuring and shows that the company will not face any solvency issues in the near future. Let's take a short break, and we'll continue our ratio analysis in the next video.